mechanism between supply and demand. If the demand in any one sector exceeds the supply, the price goes up. If supply exceeds demand, the price goes down. Marketers in each sector try to maintain a supply that does not exceed market demand, while ensuring that there is still a sufficient supply to meet the demand. Producers hold stocks of crude oil. Refined products are held at refineries, terminals, distribution points, and at retail outlets. The supply of crude oil is limited by the physical ability of major producers to draw sufficient quantities of crude oil from their reservoirs, the availability of transportation at any one time, and the capacity of refiners to process the incoming crude oil. These factors tie directly into the availability or supply of refined products. Supply is directly related to demand, and demand is related to the needs of the major consuming areas. For the products in greatest demand, gasoline, aviation fuels, diesel, and lubricating oils, demand remains more or less constant throughout any one year. The demand for fuel oils and natural gas used for heating is seasonal, especially during the winter in the Northern Hemisphere, where the majority of major consumers are located. To further understand the effects of supply and demand, we have to consider the geographical location of the major oil producers and major oil consumers. Essentially, the major producing areas are the Middle East and North America, including Mexico and Canada. The major consuming areas are North America, Europe, and Asia, principally Japan and China. Besides this geographical dislocation of markets, there is a vast imbalance between the major producing areas of the world and the major consuming areas. The primary producer of crude oil, the Middle East, consumes little of the oil it produces and is geographically removed from consuming areas. Each day, the Middle East produces about 22 million barrels of crude oil, but only consumes about 1 million barrels. The major consuming areas produce insufficient, little, or no crude oil themselves. Even North America, which consumes 23 million barrels of crude oil a day, only produces 11 million barrels a day. Western Europe produces 6 million barrels and consumes 12 million barrels every day. Asia and the Far East produce 7 million barrels a day and consume 20 million barrels a day. Thus, supply, where the crude oil is produced, is largely separated from the sources of demand. The markets of the producers of crude oil have to be linked to the markets of the consumers. This poses particular problems in that the crude oil has to be transported from its source to its consumers. Therefore, the availability of transportation is a critical factor in the buying and selling of crude oil. The link between producers of crude oil and consumers is made by trading crude oil and refined products at 3 principal financial centers worldwide: New York, London, and Singapore. Trading in crude oil and refined products is by far the largest part of the world's fiscal trade, exceeding all other forms of financial transaction by a wide margin. Worldwide, some 68 million barrels of oil are traded daily. The market for petroleum products is consequently very large, and marketing those products is a very big business. Crude oil and bulk refined products are traded 3 different ways. By contract, an agreement between seller and buyer for medium to long-term usage of fixed quantities. By spot pricing, the buying and selling of set quantities at a particular time, such as the purchase of a single ocean tanker load. And by futures, a series of financial instruments that are usually based upon the expected price of a certain quantity of crude oil or finished products, fixed at a set point of time in the future. The first two price mechanisms comprise physical trading, and the last is a purely paper transaction since no actual delivery of product takes place. The trade of paper products is based upon pricing differentials, which calculate the variance between the price now and what it is expected to be in 1 or 2 months' time. If the price is higher for future stocks than the present price, the market is said to be in contango. If the price for futures is lower than the present price, then the market is backward dated. Futures and related financial instruments were developed in an attempt to stabilize supply and demand over the long term. Producers and refiners both maintain stocks and inventories. Producer and consumer governments also hold strategic stocks to guard against excesses in supply or demand. Overstock pushes prices down. Understock pushes prices up. Seasonal variations, as we've already noted, affect price as do regional variations. Country and local taxes are also used to control demand. The price of the product at the outlet plays a significant part of keeping demand in line with supply. For example, in the face of a shortfall in supply, the price of natural gas, heating oils, and gasoline may rise steeply to restrict demand. An important mechanism in the attempt to stabilize the oil market is the coordination and oversight of OPEC, the Organization of Petroleum Exporting Countries. OPEC was formed in 1960 by most of the major producing countries in order to assist them in matching production with expected demand. OPEC's principal concern is to prevent the unpredictable and potentially damaging effects of unregulated competition among its member countries. OPEC attempts to keep supply stable by setting quotas that are based on the amount of oil produced by each country. Usually, potential production is slightly underestimated to prevent oversupply and to allow producing countries to respond to increases in demand if they occur. Marketing refined products from the refinery or terminal requires the signing of medium to long-term contracts with large industrial users. Generally, such users have either their own storage facilities to be filled regularly by road or rail tanker, or the product or feedstock piped to them directly from the refinery or nearby terminal. The demand for bulk refined products mainly consists of petrochemical feedstocks for industries making chemicals, plastics, and pharmaceuticals, heating oils for industrial plants, and diesel and heavy fuel oil for electrical power plants, ships, and standby electrical generators and the like. Fleet transportation users such as trucking companies, airlines, and shipping operators require gasoline, diesel, jet fuel, lubricating oils, and bunker fuel delivered from a terminal. The marketing effort is constantly improving the efficiency of the product stream. Fleet users continually strive for better prices and contract conditions. In the retail sector, marketers concern themselves with maximizing the number of retail outlets. If outlets are owned by refiners, then sole sourcing captures wholesalers and retailers through networks such as gas stations, service centers, and commercial outlets. Entire chains of networked retail outlets are constantly monitored through the frequent collection of data on sales and revenue, and of which products move best. In addition, marketers of finished products are constantly identifying and analyzing the completion, marketing trends, and opportunities. Lastly, marketing strategies for finished products absorb the short-term and long-term effects of constantly changing country, regional, and local legislation and regulations that affect the finished products, and health, safety,